The S&P 500 closed about 1% lower here today. About two-thirds of the stocks within the market closed in the red, and actually all 11 sectors closed in the red here today. A lot of our conversation in tonight's video is going to revolve around the rising US dollar and what that means for other asset classes around the globe. We'll also have a chat about all of our 15 open trading positions. Since I'm going to be going on vacation here for the next week or so, I'll be away from you guys on options expiration this coming Friday. So we'll go through those trades in tonight's video and see if we need to make any sort of maintenance with them. And then we'll get into a trade application example for a new idea where I wanted to sell a put on a dividend growth stock with a very wide economic moat. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 12th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and sign up for our email distribution list if you haven't done so already. So that way you can be notified whenever we post these videos. Now, do keep in mind that we'll be on vacation here for the next, week or so. And so today is my last presentation for the Market Outlook video until next Thursday. David is currently already on vacation, and my understanding is that he'll be coming back this weekend. And so I don't know if he'll be able to do a weekend video or if he'll wait until Monday. But the point is, if you're on our email distribution list, you don't have to be left guessing. You'll find out whenever we send out those email notifications. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here, and looks like it was more of a down day than an up day. In fact, for just a little bit of time, a brief amount of time near the end of the trading session, we were down 1%, but we had a little bit of a pop right there before the closing bell, and we finished down just shy of 1%. But you can see it was a pretty broad-based sell-off here today. Most of these squares and rectangles in front of us clearly are in the red or maroon color, signifying selling pressure. Only a handful of stocks closing there in the green. An obvious example there is Apple, which is much to my chagrin. We'll talk about some of our open trades here a little bit later in the presentation tonight. But that is one that I was kind of hoping was going to go down a little bit instead of going up, but that's the way the cookie crumbles. You can see there were a few other tech players that were in the green. Qualcomm, Texas Instruments, that's one that I highlighted last week that had recently hit its blue line on the dividend stair-step chart. We also saw Micron up over 2% today, so a pretty good day for it. Lam Research was also up. In terms of who the biggest movers were to the upside today, you could probably throw Boeing into the ring there. You can see that Boeing had a really nice day, up about 7%, as there was some good news around their MAX jet and some sales orders coming in at a more brisk pace than what they've been experiencing in recent years. We also saw that there was some positive movements within the airline companies themselves. So we've got Southwest Airlines that were up 4%. We had United up 8%. We had American Airlines up nearly 10%. And then Delta Airlines were up 6%. Now keep in mind, they've struggled here up until recently, and so perhaps just some dead cat bounce that's taken place there. We'll have to see. Also, of course, in the news here recently has been Twitter. It seems like the saga goes back and forth on the day. Most recent thing I heard here late this afternoon is that Twitter has now officially sued Elon Musk, trying to force him to buy the company at $54.20, the price that he had originally stated he would buy it. And so it's going to be interesting to see how that shakes out in the courtroom in the years to come. But that stock did have a little bit of a bounce back of 4% today after selling off hard yesterday when it was originally unveiled that Elon was going to walk away from the deal. You can also see that Cummins was up today, about 2%. Some of you saw me tweeting about that one earlier today. They did raise their dividend, I believe, for the 17th straight year. So not quite a dividend aristocrat there, but working on it, hopefully here within another 7 to 8 years, maybe they'll become one. Of course, their business model has a few question marks around it, since that company kind of has its business model revolving around internal combustion engines. But they've got some interesting irons in the fire, and they do hope to kind of go green themselves at some point. So it's going to be interesting to see if they can pivot in the years to come. But that has been a regular grower of the dividends and had a very nice 2% day there today. We did see that T. Rowe Price was up a little bit, Franklin Resources was up a little bit, Invesco was up a little bit, Northern Trust was up a little bit. Pointing that area out, not because they were big moves, but when we get started with earnings season, as we are this week, the first thing that should come to your mind is banks and financials in general. Later this week, we're going to hear from JP Morgan, we're going to hear from Bank of America and Wells Fargo and Citigroup and Goldman Sachs and Morgan Stanley and BlackRock, and all those companies within the next week or so will be reporting their earnings. And so we'll see how they've been handling these higher interest rate environments and higher inflationary environments as well. In terms of some of the bigger losers here today, I did notice that ServiceNow was down tremendously today. It was down about 12%. As I understand, their CEO was being interviewed on, I think it was Jim Cramer's show last night, and so apparently the market did not like what he had to say as that stock nosedived here today following up that interview. We also saw some of the semiconductors that are directly related to solar energy struggling today. So Enphase Energy was down 8%, Solar Edge was down about 5%. Notice that all of the energy stocks, so your traditional oil and gas stocks, were in the red today. Not a single one of them closed in the green. From what I can tell, it looks like Coterra was down just 0.19%, so that was about as close to break even as you got. But otherwise, another sell-off day for those oil and gas stocks, and it kind of seems like a month or so ago, when I spent that extra time in this presentation on the commodities 12 grid, that did seem to be a big moment in time. We just have not been able to recover those grounds since that big breakdown type of a day there. So the oil companies should report very solid earnings here as we kick off earnings season. It's just a matter of whether the market wants to believe whether the future earnings will also be solid. We know that in the past, oil prices were high last quarter and profits were probably pretty strong. But the question is, where do we go from here? And a lot of that, of course, hinges on Russia, Ukraine, inflationary pressures and the like. But, for the last 2 or 3 weeks, it's been a situation where sell first, ask questions later. Those oil companies have been in their own little house of pain. All right, let's go ahead and now pop on over here to the main part of the platform. And wanted to show you here that in the S&P 500, we do have 171 stocks that were up today, 330 that were down today. So that's about a third to two-thirds split there. So a third of the stocks up, two-thirds of the stocks down. I would say that that's probably around what I would have expected on a day where the market was down nearly 1%. So it wasn't one of those complete washout days. There were still places to hide, but certainly leaned in the bears direction here today. Let's go ahead and now pop on over to our traditional 4-grid. And you can see here that today was an important day from a posture perspective. For those of you that are newer to this video, be aware that this video has its roots in the market forecast technical indicator. In fact, in the old days when David and I worked for TD Ameritrade, it used to be called the market forecast video. We did have to change that once we left to the market outlook video that you're now watching. But the point holds true that we still use the market forecast technical indicator as kind of the driving force behind the content of the video. And so if you ever hear us say things like, the posture of the market is bearish or the posture of the market is bullish, what we are referencing, unless we say otherwise, is what is the green line on the market forecast technical indicator suggesting from a posture perspective. Now, for those of you that are newer to it, be aware that that market forecast technical indicator you can only find on the TD Ameritrade and Thinkorswim resources that are out there. It is proprietary to them. And so you're not going to be able to find it like on Vanguard or Fidelity, or Interactive Brokers or the like. So be aware that some of you might not have access to it if you're joining us from somewhere all around the world where they don't have access to TD Ameritrade or Thinkorswim. Then your value of watching this video is listening to our analysis on this particular technical indicator, even if you can't access it yourself. And we've tried to make it easier for all of you that are viewers of this video to understand what the posture is by using a color-coded mechanism in the background of these charts. Remember, if you're a premium member of Market Scholars, you are awarded all 50 plus of these customized charts that you see David and I using during these presentations. So it's a big perk for joining us for our 3-year premium plan. And if you're one of those, if you're following along at home, this chart is 4B. Now the background colors, you'll notice on 3 out of the 4 charts turned pink today. So that's why I mentioned a moment ago that today was a pretty noteworthy day for the markets. Now, keep in mind this was actually the 3rd straight sell-off day for the S&P 500 after having a 4-day rally. So you can see we've had some chop and slop here recently where the background's kind of gone from pink to green to pink to green and now pink again. And the reason for that is we haven't been able to sustain a trend. Remember, if we have a sustained trend to either the upside or the downside, then you're going to see more prolonged background colors as well. So like back here as an example, this was more of a sustained downtrend that we were dealing with back here from April to May. But we've tried to stabilize here recently, and while we haven't been able to actually put forth an effort for a bullish posture or trend change, I should say, at least they've kind of stopped the bleeding, so to speak. So you've had these opportunities for the intermediate posture, which is that green line I referenced down below, to kind of go from bullish to bearish to bullish to bearish. And today we're back to that bearish again because of the 3-day sell-off that we've been experiencing here. And you can see that the intermediate reading is at 42 and falling. You can see that within the label of the indicator itself, and that helps us understand whether the posture would be considered weak or strong. And right now we would consider that to be a strongly bearish posture once again, because the reading of 42 is below 50, which is the midpoint of this technical indicator. So when this is rolling over and below 50, we consider that to be strongly bearish. If it were up here at like 68 or 65 and rolling over, then it would be more of a weakly bearish posture at that point. So for instance, back here you can see the background color of the chart was light pink for just one day before the very next day going to dark pink to kind of confirm that that was a more bearish type of a condition right there. So point being, for as much as it's felt nice to have a little bit of reprieve from the selling here in the last month or so, it really hasn't done a lot to change our longer term view of this market, that we are still in a more dangerous market. This is a very difficult time. Remember, that will happen. That's part of what you sign up for when you become an investor or a trader. Markets will be difficult during certain years. We're dealing with one of those right now. As we mentioned here, a couple of weeks ago when we were talking about the first half of the year statistics, it was somewhat eye-opening to me that for the first 6 months of the year, so the first half of this calendar year, it was literally the worst start to the year in my lifetime. Not to unveil how old I am or anything like that, but I'll just simply say that the last time it was this bad was back in 1970, and I was not on this planet yet. And so, point being, this has been a difficult year. And if you're newer to investing and trading, you might be wondering, is this normal? What did I, get myself into here? This stock market thing is hard. It is hard. There's no doubt about that. But the truth of the matter is, you are being thrown into the gauntlet right now. This is a very difficult trading experience that we're going through. And these types of things do happen, typically at least once per decade. So the good news is it doesn't happen every year, but the bad news is you do occasionally have to stumble into these very difficult markets, and that's where we find ourselves right now. And despite the stopping of the spilling of blood here recently, we still have a tilt to the downside of the market, right? We can just look at these charts, and if we're honest with ourselves, we can recognize that if we're trying to read the charts, right? We have not been able to really stay above the moving average. If you can't stay above the moving average, you cannot start putting in an uptrend. So it's got to start with that. And we just haven't been able to do it. The S&P 500 went right up to that falling 30-day moving average 2 times in a row, kissed it, and then moved right back down and away from it. Over here, it was able to stay above it for, a week or a week and a half, but even that did not show much progress. It was like, hey, I got, the index got above the moving average, went sideways, did not progress higher, and then immediately failed. Right? And so this is not a good look that we have right now, where it's giving you that impression that the sellers are still in control of these market conditions. The NASDAQ, we're getting a little bit more constructive on, because you had a little bit bigger push through that moving average here about 3 or 4 days ago. But even there, notice you didn't have any separation between the price action and the moving average. Those were pretty big days where you might have been able to get above the moving average by 1 or 2%, but notice that both of those days, the lowest point of the candle was still touching the moving average. What you'd like to see is some actual air pockets, or some breathing room between the low of the candle and the moving average itself, and we just have not been able to do that. Right? And so, again, not a great look. And it doesn't mean that it can't change. That's the nice thing about the markets here in the United States. When we go through these earnings periods, it gives the market a chance to reevaluate, to look at how businesses are actually doing. And while the stock market is a voting machine in the short term, it's a weighing machine in the long term, as Benjamin Graham once said. And so you would like to think that stocks will eventually follow suit of their earnings, but that's more of a longer term concept. In the short term, it's really driven by Wall Street sentiment. And right now, sentiment just simply is not great. This is a market that has been dominated by the bears so far in 2022. And right now, I don't have a reason to believe that's going to change. We've got a big number coming out tomorrow. The CPI number is going to be out tomorrow, so it's a big economic release. Sometimes CPI is less important. Right now, of course, with inflation being front and center as to why this stock market is stumbling as much as it has been, then a CPI number is going to be hugely important. So keep your eye on that possibility where, the market could react pretty strongly to that number tomorrow. But this is a market that is concerned that with rising input costs, the companies that sell products and goods to the consumer, of course today being Prime Day for Amazon and a few other retailers out there, they're not going to be able to clear as much profit margin. If, let's say the input costs of building a product goes up 15%, but they can only hike the end cost of the product by 8%, that is a slimming of the profit margin that usually is a bad thing for investors in investors' eyes there. So that's kind of the market that we're dealing with at this moment in time. And again, it just kind of feels to me like it's a market that is sell first, ask questions later. Sell first, reevaluate. Sell first, take a deep breath. But the point is, it always starts with sell first, and you get enough people selling first, and that's what creates the selling pressure to push prices lower. This is not a market that has felt to me like we've had people give up en masse yet, right? We talked about that earlier this year as well. Have we taken a beating? Oh yeah, we've taken a beating. A lot of us have suffered with our long-term portfolios. But are we on the verge of saying, just huge amounts of the investing public had just thrown their hands in the air and given up? No, and that's kind of the scary part, because what if that is still to come, and what is it going to take to get there? Is it going to take the market going down another 20 or 30% from this level before people literally start giving up? And we're just not there yet. I of course also traded during the 08-09 great financial crisis, and I can tell you, just at least from my own mindset, that this has been a walk in the park compared to 08-09. Back then, it was a true psychological battle where you literally didn't even want to wake up the next morning to look at how the markets were going to open. You didn't want to peek at the Wall Street Journal. You did not want to open up your your 401k statement when it came in the mail. And while things have been bad this year, it doesn't seem like they've been to that extreme to me yet. Now, obviously, we all have our own anecdotal experiences there, but to me, it feels like we still have damage that needs to be done before this whole cycle kind of works its way into more of a bullish condition. Now, one possibility for how this could play out is, there's a lot of work that's done in the Stock Traders Almanac. So for those of you that are familiar with that, you'll know that Jeffrey Hirsch puts that out every year. I believe his father, Yale Hirsch, started it many years ago. But they include a lot of interesting market statistics, and one of the things they track are election years and midterm election years as well. And there oftentimes is some sort of a bounce into those markets, and so possibly we could get some sort of a tradable rally, or at least the selling will not be as intense between now and kind of the end of end of October, early November, whenever the elections are. But it's possible that after that kind of catalyst has been removed, that we're right back in this funk, and we're still dealing with these selling types of behaviors for the better part of the next year, right? The typical bear market tends to last about 18 months. And so, while this has been a difficult time, we've really only been mired in it for 7 months at this point. So we kind of have to earn our keep through both price and time, and we could still have to take some lumps on both of those counts going forward if you're looking at, let's say, the next year plus. So we'll keep our eye on the situation as always, do our best to relay our thoughts and opinions and experiences with you here in these videos and during our premium trading room classes that we teach daily at Market Scholars. In the end, we don't have a crystal ball any more than you do, but I would just say continue to act with caution. This does not feel to me like there was some sort of a major capitulation type of a bottom that was set here a month or so ago, and that there's going to be opportunities to trade, but the path of least resistance appears to still be to the downside at this moment in time. And I hate to be the bearer of bad news, because I know my accounts do better when markets are bullish, but it is what it is, and I've got to call it like I see it. And right now it just seems like the bears still have more control than the bulls in this market. So after today's selling, you can see that we only have one index that remains with a bullish posture. Now granted, it's a weekly bullish posture. Notice the light green color here on the Dow Jones Industrial Average. It has had its third straight sell-off as well, but because it hasn't sold off as aggressively as the S&P 500, it's managed to retain that weekly bullish posture. But I wouldn't hold my breath on that. If the market sells off again tomorrow, I would say there's a very high likelihood that the Dow Jones will follow the other three into strongly bearish postures at that moment in time, because you look at the Dow's chart and it doesn't look all that much better than the others. It's just that it is filled with those blue chip companies that don't move around with so much exaggeration. And so you still see a situation where you've gone up to the moving average and you're rolling over on the underside of that falling moving average there. So that doesn't bode well, unless we have a very good response to the CPI number tomorrow, and anything is possible, of course. But judging by what we know right now and what we see, these charts don't look great, right? We're thankful they've gone sideways, but you certainly wouldn't say that these are strongly bullish types of charts that you want to see if it's in a real risk-taking type of a market. So we've got work to do, I guess, is the long and the short of it. So to put a ribbon on it, we were down 0.92% on S&P 500. We were down 0.62% on the Dow Jones. We were down 0.95% on the NASDAQ Composite. So that was the worst of them here today. And then the best of them here today was actually the Russell 2000, down just 0.22%. Now keep in mind the Russell 2000 has kind of an interesting advantage in this market right now. Many of you have been looking at what's been going on with the dollar. I know we've certainly been discussing it in my trading rooms, and of course I've been bringing it up with you guys here in these free videos on YouTube as well. But in case this is the first time you've checked out this video, just be aware we are in a very, very strong dollar environment. In fact, I believe today was the first time in 20 years where the US dollar was at parity with the euro. So if you've ever wanted to take a European vacation, now's your moment in time to take advantage of that, I suppose. But point being, the Russell 2000 is an index that tracks small cap companies here in the United States. Many of those companies only do business here in the United States. So think about like regional banks or small local banks or those types of things. They're not large enough to be in the S&P 500, and so they're kind of the smaller companies that would fit better in the Russell 2000, but they're not doing business in Europe. They're not doing business in China, right? Those are usually places that the big international companies like Coca-Cola and Procter & Gamble and Intel and Apple and all those companies that are so well known across the globe, of course, do business across the globe. But here in the United States, there might be a little bit of a benefit with the smaller cap companies right now. It's not tremendous. You're not seeing like the small caps go up tremendously while the rest are going down or anything like that. But today was an interesting day where normally you would expect the more speculative area of small caps to do worse on average than other types of securities out there. But instead it was the opposite. They actually did better. And it might be because this is an environment where the US dollar is getting so much press for being how strong it is at this moment in time. Remember, a lot of small cap companies in the United States might use that strong dollar to order goods and products or input commodities from overseas, convert them into a finished product here in the United States, and then sell them here in the United States. And so they get a built-in benefit there where their dollar stretches a lot more on the front end when they're buying their merchandise, but they don't have the negative aspect of selling it in a foreign overseas currency. They get to sell it in US dollars after it arrives on our shores here. So anyway, something to keep our eye on just in case it becomes a bigger and bigger issue moving forward. So we've got a strongly bearish posture on the S&P 500, a strongly bearish posture on the Russell 2000, a weekly bearish posture on the NASDAQ Composite, and we still have a weekly bullish posture on the Dow Jones Industrial Average. Let's step away here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. As many of you are aware, they take quite a long time to produce, which is why we can't do them when we're on vacation. Lugging all of our equipment with us and all that kind of stuff just wouldn't make any sense when we're supposed to be unplugging from the markets and spending enjoyable quality family time. But it takes about 3 hours, if you can believe it, to all in when you're talking about the research that goes into the trades and the notifications and writing up the paragraph that goes with the video every time and actually doing the video and then doing the editing and the uploading and sending out the email notifications. It's a huge process, and many of you know it's just David and I that work here, so it's not like we've got a bunch of interns running around doing this for us. So we really have to ask ourselves, is it worth it for us to do these videos every single time that we do it? And what I have told you guys in the past is, as long as 100 of you get value out of my 3 hours that I commit to this, I'm willing to do it. If less than 100 of you get value out of it, then you can understand why I would be less enthusiastic to put the time and effort into doing it. So every time you guys can have at least 100 likes for me there on Twitter, I'm happy to do a full-length video the next time I'm scheduled to do the video. Now again, I'll be on vacation here for the next week or so, so the next time I do the video will be next Thursday, not this Thursday. But if you can get me 100 likes between now and then, I'll be happy to do a full-length video just like I'm doing at this moment in time, because the last time I did the video, 105 of you clicked like. So thank you to all of you. I appreciate It's a Revolution. I appreciate Mark II. I appreciate Tammy. I appreciate Was Tesla Up Today? That's an interesting handle. I appreciate Ken and Sedona and Kevin, Dave, Rick, Leah, Prickly Trader, Thomas, Vodacon, Catherine, Ed, Robert, Warut. We've got Nick, HR, Michael, Norm, Paul, Claire, Jason, Jerry, Keola, Tom, Richie, Roger, Lena, Paul, Gerald, Ayakipa, DGI and Options Daily, Jayesh, Ray, Ken. Too many to go through, but I appreciate each and every one of you, 105, that took the 5 seconds out of your day saying, hey, Brandon, I'd really like you to do the video next time, a full-length video that includes a trade application and all the extra charts that you bring with it. So thank you to everybody who did that, and I hope you can do that again moving forward. While we're over here on the internet, a reminder that I did teach my dividend growth investing class today. In fact, today was a somewhat special day in that we bought a stock that I've been kind of hunting for quite some time at this point, a stock that we had not bought a single time in my dividend growth investing classes that, remember, I've been teaching since basically 2014, if you include the time back when I was with TD Ameritrade. So it's pretty rare for me after all these years basically teaching a class every single week. So that's like, 50 classes per year over the last 7 or 8 years, and to have a completely brand new company that we've never bought before in my trading room. But that happened today. And remember, that can happen a little bit more often when the stock market is in a bad mood. When the stock market's in a bad mood, your pool of potential candidates widens much more greatly than when the stock market is in a great mood. Because remember, as dividend growth investors, we prefer to buy stocks after they sell off, not after they go up in price. Because after a stock sells off, their dividend yield goes up, and we get a built-in benefit for being brave to do that. So today we did buy a company for the very first time. If you're curious about that and you're a premium member of Market Scholars, remember the recording is already posted here on the Trading Rooms calendar. Tomorrow, by the way, I will still be here for one more day for my trading rooms. So I'll be here doing the factor-based swing trading class tomorrow at 11 a.m. Eastern time. And then Thursday is when I take off bright and early for a 2-day road trip across the country, and then spending some time with family, and then making the road trip back home the following week. So I'll miss you guys, but I'm sure you'll do just fine without me. And I'll do my best to tweet while I'm away as well, so that way we can kind of check in with you on occasion. Anyway, as we take a look here at the sector selector, you can see that this has been updated as of Friday's close. So this is July 8th's information here. So a couple of days stale at this point, but still an interesting set of rankings to kind of discover here, where we had consumer staples stay in the top slot now for the third straight week. That one wasn't quite as noteworthy, but one of the things that's definitely catching my eye, because I happen to be a big fan of healthcare companies, is the big move in those healthcare stocks. They've made their way all the way up to the number 2 position, which, as you can see, is the highest positioning for healthcare over the last 3 months plus. And they've been kind of just steadily climbing the rankings along the way. Not necessarily doing it in huge, leaps and bounds, but just kind of consistently, chipping away at the rankings and becoming more powerful along the way. I know we bought a healthcare company yesterday in my top-down trend trading class, because that's where you're finding some of the better trends right now. I know I also talked about, CRISPR Therapeutics the last time I did the video with you guys here last week, and I was saying how it was kind of eye-opening to see CRISPR, of all stocks, up on a year-to-date basis. And I noticed it was up another 7% today to a new year-to-date high. It's not at a 52-week high because it was trading higher late in 2021, but it did touch its 2022 high here today. And so it's not just pharmaceuticals, right? For a long time, we were talking about how it was the major pharmaceutical companies that were getting the benefit of the doubt because they are more defensive by nature. So you saw stocks like Merck, Eli Lilly, Bristol Myers Squibb, could probably throw Johnson & Johnson in there. Those companies have all done well this year. That's not any sort of new information. But to have a stock like CRISPR, which makes zero money whatsoever and is unlikely to make money anytime in the future, they technically brought in a partnership income with their partnership with Vertex, but that was not as a result of selling product. It was just kind of an upfront payment for their partnership. But the point is, those are the most speculative side of healthcare, right? Those biotech companies that basically have zero revenues and profits. They're even holding up reasonably well in recent weeks. Some of those Cathie Wood types of biotech companies are perking up a little bit more. Now, we don't want to make too much of it because many of them have fallen tremendously over the last year, but there are a few little green shoots there. It's not just the major pharmaceutical companies right now that are perking up. You're actually seeing some of the most speculative areas within healthcare also pulling their weight at this moment in time. You'll also notice that we've had a little bit of a spillover in some key areas. First of all, utilities fell from number 2 to number 3. Some of you saw me tweeting about utilities over the weekend because as part of my regular routine, I go through, I don't know, probably about 50 different charts of possible candidates for my Monday top-down trend trading class, and utilities were still in our purview because they continue to be in the top 4 of these sector rankings here. But after I was going through the utilities, I'm like, man, this is awful. Chart after chart after chart just looks like utilities are rolling over underneath their falling 30-day moving average. And you can see that's even worked its way into the rankings where there's a little bit of a letdown there in the rankings. So, be careful with those utilities. We'll just have to see where we go from here, but some of them look like they're looking a little bit less ideal on the charts. In fact, we have traded one of those, right, last week when I did the short sale on, I think it was Xcel Energy, that utility from Minneapolis, St. Paul area. So, but they're not alone. A lot of the utilities look exactly the same way, where they're really rolling over underneath their falling 30-day moving average, and therefore there could be more room to the downside on those types of securities. Another area, of course, that we talked about endlessly in 2022 is energy. And look at, my oh my, how the mighty have fallen. Remember, when energy was up here at the number 1 ranking on June 17th, it had literally been in the number 1 ranking spot every single week in 2022. Just by sheer coincidence, it was not ranked number 1 the final week of December, but starting with the first week of January of 2022, energy went to the number 1 position, and it never relinquished its grip hold on the number 1 slot until this week of June 24th, where it went from number 1 down to number 3. Then it fell another slot the following week, and now it's fallen all the way down to number 6. So you've literally lost your champion up here at the top of the hill that has now fallen so far. That champion is now in the middle of the pack. There's some interesting statistics out there that suggest that energy is actually off of its 52-week high to a greater degree than technology is at this moment in time. That's how quickly those oil and gas stocks have just collapsed here in the last month or so. So they struggled as well. And then materials fell pretty hard as well. And they're all the way down here at the dead last position all of a sudden. Materials kind of suffer from some of the same things that energy does. They're both commodity-focused areas, and of course commodities have it's almost like the fever broke a couple of weeks ago or whenever it was, and it just seems like, inflation kept pushing prices higher and higher and higher and higher to the point where it was almost self-fulfilling that it would break the back of the economy, and eventually economic activity would slow down, and that would be effectively what would cure the disease of high commodity prices. And now we're seeing the flip side of that, where those commodity prices continue to slide. And so all those iron ore and steel companies and all that kind of stuff that make up the materials suffering in this environment as well. All right, let's go ahead and get back on over to the main part of the platform, do some 12 grid analysis, and we'll get started here with, where is it? Chart 5A, our asset class 12 grid. All right, so as this gets pulled up here, you can see we've got a little bit of a mixed bag. We've got some green charts, some pink charts, and as I always like to remind you, that's fairly typical on this first set, because remember, these are not all stocks. They're not all bonds. They're not all cryptocurrencies. They're not all commodities. They're a mix of all those things. And naturally, money is always rotating from one area to another. So it's almost always going to be the case that there's some green and some red. But it's a pretty split decision this time around. It's a pretty even, split between green and red at this particular moment in time. So let's go through them and see what we can learn. Let's get started with the one in the lower left-hand corner here, because this seems to be the talking point of the financial media here lately, and I've already kind of brought it up earlier in the presentation, but now you can just kind of reiterate it with your own eyes. The US dollar is absolutely en fuego. It is on fire to the upside. And while that may sound like a good thing, depending upon your situation, again, if you're traveling to another country right now from the United States, you're thrilled about that. But remember that a rising US dollar is not something that I personally prefer. I would actually like the opposite because as a dividend growth investor, I tend to focus on big multinational blue chip companies that do a lot of business overseas. And that's not really doing them any favors. There's some of them that can withstand it better than others. Naturally, every business model is a little bit different. But in general, if you ask me point blank, would you rather have a strong dollar or a weak dollar as a US-based investor? My answer would be weak dollar, and that's not what we're getting right now. And so that causes reverberations across a number of different markets that are out there. Most obviously, commodities tend to struggle when the dollar is strong because most commodities globally are priced in US dollars. In addition to that, you also find that foreign assets also tend to struggle. And that includes the stock market. And it also includes companies that are multinational, that are technically headquartered in the United States, but do a lot of business over in Europe or Japan or China or what have you. So, it could very well benefit some of the smaller companies, like I mentioned before with the Russell 2000 here in the United States. But for the most part, a strong dollar environment is a little bit more difficult environment for a lot of investors, myself included. So let's kind of go through the damage here. First of all, US dollar was basically break even today. Yesterday, it hit a new multi-year high, and it continues to have a strongly bullish intermediate posture and remains above a rising 30-day moving average. Off to the right-hand side, you'll then see the damage that it's done to commodities. Look at what's happened to gold. I mean, this has been unreal to witness. You usually would think, hey, if you could tell me a year in advance that we're going to have the highest inflation that we've literally seen in 40 years, would you want to be a buyer of gold or not? Well, I think a lot of people, without knowing what actually happened, would say, yeah, I've always heard that gold is a great inflation hedge. Well, take a look at this chart and rethink that. This is GLD, which is an ETF that's designed to track the price of gold itself. So not the gold mining companies. This is actually gold, the commodity. And you can see it has been a house of pain for the entire 3 months of this chart. It's been so bad that you're actually seeing a bit of a rarity here for GLD. You have 5 days in a row of oversold cluster signals. I mean, you could probably go back quite a long time and not see that sort of a thing. You can, when I blow up the chart here a little bit more, you can see that in better detail with those 5 green dots down below and those 5 green dots up here under the price candles. Basically, those represent oversold cluster signals when you've got the blue line, the red line, and the green line of the market forecast indicator in the lower reversal zone below 20 on the same day. You can see you had a few sporadic ones back here, but this is fairly rare to my recollection. Remember, we've been doing these videos here for a long time, so it's not like, this is my first week doing it or something like that. This is pretty rare for GLD to have 5 in a row. I don't know if we could go back on like a 1-year chart to give you some context there. You can see, again, more sporadic oversold cluster signals that occurred back here, not 5 in a row. If we went and let's change this to a 3-year daily chart. Here you had quite a few of them bunching up, but I still don't think you had 5 in a row. Let me kind of zoom into that time period where you saw a few more of those showing up. And no, you didn't have 5 in a row. You had 2 in a row, you had 2 in a row, you had 2 in a row, you had 2 in a row. Back here you actually had 3 in a row. But you never had 5 in a row. This is really, really rare to have 5 in a row that we are witnessing right here, right now on GLD. Now, whether it amounts to anything is anybody's guess. Every market environment is different. If the US dollar stays strong, then the odds are against some sort of recovery for gold. If the US dollar has gotten a little bit too hot, which oftentimes happens, right? It happened back here. Notice the US dollar got these 2 overbought cluster signals with these red dots. That basically means things have gone up a little bit too fast and there might be a pullback on the horizon, which there was immediately after that in the US dollar's case. So eventually, if we get too far away separated from this moving average, we're just going to not be able to sustain those types of moves unless there's some sort of an exogenous event that's taking place out there. But in just the normal occurrence of trading, that typically does not happen. And so it wouldn't surprise me at all if the US dollar does roll over a bit. Now, that doesn't mean that I expect it to break trend and now all of a sudden go into a downtrend. I'm simply saying that it's going to be hard for it to sustain this level above its moving average. So if it were to roll over a little bit, reestablish a new higher low, that'll give those folks that are trying to buy these oversold cluster signals on gold an opportunity to watch GLD get maybe back up to this falling 30-day moving average. So is it a riskier game to play? Of course, because this is a downtrend clearly, and you've got to be careful with those. But sometimes things can be taken to an extreme, and you could probably get away with saying things have gotten really extreme for gold right now. 5 days in a row of oversold cluster signals. It would not be surprising at all if we had a few up days here in the next week or two with GLD. So let's keep our eye on that possibility. Notice here that US oil, or USO is the ticker symbol, but this represents oil from kind of an ETF perspective. You can see that it has struggled yet again. It was down about 7% here today. You're basically at your lowest close in 3 months, right? There were a couple days where the intraday trading was a little bit lower, but where we closed today on USO was the lowest close on a daily candle basis in over 3 months. And you can see we are way down below that falling 30-day moving average there as well, kind of similar to what we saw with gold. So you can see the major impact the strong US dollar has caused on commodities. And then if you look up here at where our foreign stock markets are, you can see similar destruction of capital. EFA represents the developed foreign stocks. So think about Europe, Australia, Japan, Canada, that sort of thing. They've struggled. They were down just a little bit here today, but they've been selling off for quite some time and have a strongly bearish posture right now. In fact, they've got an oversold cluster signal there as well. Emerging markets, so that's where you're going to find China, India, Russia, Brazil, that sort of thing. It was down a little bit worse today, down 0.38%. And again, it's been in such a downtrend that you now have an oversold cluster signal there as well. So notice the separation between the current price of EEM and its moving average, the current price of EFA and its moving average. Then look at the United States. The United States is a lot closer. Now, the United States still doesn't look good. That's not the point I'm making. But the point I am making is that the U.S. has actually been able to hold up a little bit better during this last 2 or 3 week period because we are not as directly damaged when the U.S. dollar is strong. The foreign markets are, at least in terms of the US dollar, which we of course look at for this video here. So, the dollar is a very powerful tool. Even if you're not trading it directly, understand how it can impact the stocks and the other commodities and things that you might be trading indirectly. Now, beyond that area, of course, a lot of talk this year has been around interest rate environment. We actually did see the 10-year Treasury yield fall a little bit today. We're back below 3%, so we kind of been flirting with that 3% number here. So we're at 2.95% at this moment in time. That allowed long-term bonds themselves to pop up in price just a little bit today. And notice long-term bonds remain above their moving average. Remember, we can't say that about the stock market. Remember, both the stock market and the bond market have been absolutely blitzed this year. Usually that's not normal either. This has been a weird year for a lot of reasons. But at this moment in time, you could get away with saying the rebound in the bond market has actually been a little bit more impressive than the rebound in the stock market. And part of the reason is maybe this economy just simply can't withstand these high interest rates up here at 3% levels when the world's kind of been used to, let's say, 1% interest rates for the good part of the last couple of decades. So we'll see how that all plays out there as well. But just to be official about it, we are back below a 3% yield there on the 10-year Treasury. By the way, Bitcoin was down quite a bit today. I believe it was down like 5 or 6%. Remember, this one's a little bit harder to read because of when the contracts roll over. But point being, you can see here that Bitcoin is back below 20,000, not even by just a little bit, pretty tremendously below 20,000. It's at 19,300. So again, risk appetite is just not what it once was. Last year, you could get away with being sloppy. Just throw money at it and that problem corrects itself. This year, the market is not being accommodative towards that idea, and it is punishing people who are speculating a little bit too aggressively. Let's go ahead and take a look now at our sectors. This will be chart 5C for those of you that are following along at home. And you can see that after today's damage, and really it's been kind of a 3-day sell-off as I mentioned before, there's only a couple of areas left in the green. One of them is industrials, and one of them is utilities. Now, as I mentioned before, utilities don't really look that strong to me because they're still under their falling 30-day moving average. But because their intermediate line is at 51 and rising, technically it is considered to be strongly bullish at this moment in time. But I would still be more cautious around that. Obviously, I can't give you advice. I'm not your licensed advisor. But in general, I will just say that a lot of the individual utility stock charts do not look all that appetizing. And even when you look at XLU here, it doesn't look that great to my eye because you're still struggling to stay above that moving average, and it could very well bounce down and away from that moving average under the wrong types of circumstances. So, and by the way, I should have mentioned this as well. This one didn't catch my eye, but up here in the upper right-hand corner, technology is also green chart. It's a weekly bullish chart. So weekly bullish on technology, weekly bullish on industrials, strongly bullish on utilities, and then all the rest of the charts are pink. As I mentioned before, healthcare has been rather impressive. Healthcare is just light pink, as is staples, so those would be considered weakly bearish. The rest are strongly bearish, and I think that's fair because if you look at healthcare and you look at staples, they're both above their moving averages right now. In fact, they're the only ones. Interestingly enough, healthcare and staples are above their moving averages, and the 3 green charts on the board are not, right? Technology is below theirs, industrials below theirs, and utilities is slightly below theirs. So you could get away with saying that healthcare and staples are equally as deserving of saying that they've retained some strength here more recently. And I'm a little bit more hopeful around them. But then again, I recognize that I probably look at those 2 sectors with some rose-colored glasses, so you've got to be careful with what you hear from me because I happen to like healthcare and staples as a long-term dividend growth investor. So maybe I just want them to look better. But truthfully, they are above their moving averages, and we can't say that with the other sectors. So it is worth at least pointing out there. Now, in terms of who the best performer was today, none of these actually closed in the green today. The best performer was actually materials. Actually, I take that back. Communications was the best performer. It was still down, but only down 0.05%. So it basically lost the least amount out of all 11 of these sectors that are out there here today. The worst performer today was the aforementioned energy stocks. Remember when I showed you the heat map and all of the energy stocks were down today? Not a single one closed in the green, at least in the S&P 500. So it makes sense that was the sector that suffered the most here today as well. All right, before we get into our trade application example, as I mentioned before, I'll be about embarking upon a 1-week vacation, so you won't hear from me Thursday or next Tuesday like you normally would, but I will be with you a week from Thursday. So since I'll be away from you for a longer amount of time, and this just happens to be options expiration week where you kind of need to babysit your portfolio a little bit more, I thought today would probably be a good day to kind of review some of our positions and see where we stand with these market outlook trade ideas that I presented to you in recent weeks and months. Remember, David and I do keep different paper money accounts, so this has nothing to do with his trades that he's shown you. These are only the ones that I've done for you over the last few weeks and months. So let's get into that and see kind of where we stand with things here before we get into the presentation of the new trade idea. So let's go ahead and start down here near the bottom, and then we'll work our way back up to top. So we do have that short position on XL Energy. Remember, that's the utility company that I had mentioned earlier. We're doing just fine on that trade so far. We're making about $44 on that trade. Union Pacific, this is the one that I did today, so we'll talk about the setup on that here in a little bit, but we're making money on that one so far. Luckily, I did that trade about a half an hour before the market closed, right when the market was down about 1%, and as I mentioned, the market actually rallied just a little bit into the close, and I think that benefited our trade there, so we're already making $17 on that sold put for Union Pacific. T. Rowe Price, this is one that does expire this Friday, so this is one that we would theoretically want to keep a closer eye on. Only 3 days left until expiration, but this was a sold put where we have an obligation to buy it at $90 per share, and since it's at 113 right now, we are in the driver's position on that. We're up about 82 bucks at this point, so I'm not particularly concerned about that one, although I will of course keep my eye on it if I get a chance while I'm driving across the country. This next one up here, this is the QQQ ETF. Remember, that is the NASDAQ 100 ETF. And I remember when I put this one on for you guys because it was when the NASDAQ gave us a weekly oversold cluster signal. And I remember at the time, markets were really selling off hard. And a lot of people were probably wondering, why is this guy doing a bullish trade when it looks like the world is literally coming apart at the seams? And this is the reason I do that, right? It seems scary to take that trade at that time, but it has turned out profitably for us because markets don't go straight down. If you can sell on extreme oversold clusters and things like that, you're giving yourself kind of a 1 foot headed in the right direction, at least from my perspective. So we're in great shape on that trade. We basically have locked it. In fact, we could buy it back for a penny tomorrow if we wanted to. So we've made 235 bucks on it. The Qs are not going to fall from 286 down to 235 in just 3 days. So I'm going to leave that one on, and we're just going to let that expire worthless over the weekend. Progeny, this is one that I just put on here more recently. Unfortunately, that one has not worked out quite as well yet. We're down about 187 bucks on it, but remember, that one already has bracket orders on it, so I don't necessarily need to be babysitting that position like I would with an options trade with expiration coming up here on Friday. This one kind of takes care of itself from the maintenance perspective, but hopefully that one can perk up for us here as the next few days move along. Medtronic is another one that expires this Friday, 3 days left until expiration. Right now we are short the $85 put. It's trading at $88.69, so that one theoretically could drop, $3 or $4 in the next few days. I'm not anticipating that. Right now the market makers aren't either because we're making $74 on the trade, but it is one that I think I do need to keep a little bit closer eye on, and I'll have my cell phone with me and things like that, so if something goes haywire while I'm on my road trip, I'll do my best to make the necessary adjustments and send out any updates to those of you who are premium members via our Telegram app. And that way you know what we're doing with these trades. Kellogg is the next one. This one we're up 580 bucks, so it's a big winner there for us. Similar to that Synapsys trade. You don't see Synapsys here anymore because we hit our max gain profit target the other day. That was a bigger dollar winner for us, so I was really happy that Synapsys won from a bullish swing trading perspective. Kellogg is also a bigger dollar winner for us, but this one's a little bit of a goofy trade. We actually put it on a long time ago, and we were just kind of conducting an experiment where we were selling a put on a leap instead of a normal monthly contract that expired in, let's say, 50 days or something like that. So right now our obligation is to buy Kellogg at 50. It's trading at 73. We're in great shape on that one. It does expire January, so we still have 192 days left. But right now, feeling very good about that one. Intel is one that we do have to keep our eye on because it expires in 3 days as well. And this is another one where you're feeling okay about it, but you're not necessarily feeling like it's a slam dunk at this point, right? It's trading at 37 bucks right now. Our obligation is at 35. Could Intel fall $2 per share in the next 3 days? Definitely. Under really bad market conditions, that could definitely happen. So that's another one, kind of like Medtronic, that I'm going to have to keep a closer eye on as we kind of take my road trip here in the next few days. Right now, we're in good shape with making money on it. Corning, this one we don't really have to worry about as much because this is an August contract. It's another sold put where we sold the 25 strike. It's trading at 32 right now. We're up about 15 bucks on it, so doing okay with that one. But of course, they do have an earnings announcement coming up, so that can change the trajectory in a hurry. So it's not one that is pressing at this moment in time, but one we'll want to keep our eye on for the future. FMC Corp, this one expires in 3 days. I had almost forgotten I placed this trade. That's how many of these trades we do. But I'm glad we did place it because we're making 110 bucks on that trade. This one was a bear call spread, and we just simply want the stock to stay below 125. It's at 103 right now. I highly doubt it's going to jump $20 per share in the next 3 days. So that's another one that should go to max gain for us. A similar trade right above it in eBay. This is another bear call spread that I had sold. So it's another trade that we want to go down, not up. And so we would get in trouble if eBay would trade above $50 per share. With it trading at 43 right now, we're in good shape. In all likelihood, it's not going to jump, $6 per share in the next 3 days. We're up about 71 bucks on that trade. Best Buy is a little bit of a different situation because technically this is after a handful of rolls that we've already done on it. So this is one that really hasn't worked to our advantage up until this point, but it does show that we are profitable on the current roll. However, that does not include any losses or profits that we would have taken when we've rolled it to this point. But our obligation at this point on Best Buy is at $62.50. It's currently trading at 70, so we've got a little bit of breathing room there, but keep in mind that one is now rolled all the way out to September, where we've got 66 more days to be in the trade. Amgen's the next one on the board. That was an iron condor. That one's doing reasonably well for us. We're up about $122 on it at this moment in time. It's threatening the top strikes more than the bottom strikes. So in other words, it's been a little bit more bullish. So that's one where we kind of liked it where it was down to 81 cents today. Remember, Amgen has been quite a sideways stock chart in the last few months, which sets it up nicely for an iron condor purposes where you get benefits out of neutral trading. So nothing to do there, but I will keep my eye on it since there's only 3 days left. I doubt it would go from 247 up to 255, but that's the side that is the closest to being threatened. So, if there's some sort of a big surge in the stock market in the next few days, it's possible that one could end up getting me in trouble. But right now, I'm feeling pretty good about it. AbbVie is another one that expires this weekend, 3 days from right now. This is another one of those similar to FMC and eBay where we've got a bear call spread. And I think we're in pretty good shape on that one as well. We're up $116 right now. What we want to avoid is to have the stock go up beyond $160. With it trading at $152 right now, I highly doubt it's going to jump $7.50 in the next 3 days. So that should be another one that's probably going to be a max gain there for us. And then last but not least is Apple. This is one that unfortunately hasn't gone the way that we wanted it to. It's another bear call spread, and right now this is the one that is most concerning to me because of where it's trading. Our obligation or what we want for it to not do is to go up past 144. Obviously, it's already past that at 145.82. Now, it's also beyond our long strike there. And so if I didn't do anything and we fast forwarded 3 days from right now, this would just simply roll off our books in the background. We would take a loss on it. You can see we're down $34 on it right now, but we wouldn't necessarily have to do anything to kind of close the trade or what have you. So that's not what I'm worried about. What I'm worried about is if it falls from 145.82 where it's currently trading to somewhere between 144 and 145. That's something that you do not want to let happen in all likelihood, because then all of a sudden you're going to be exercised on that and you're going to wake up on Monday morning being short 100 shares of Apple stock if that happens. So you want to babysit those credit spreads much more closely if you think that the price could fall between the strikes, and that is a fear for Apple of mine right now. So that's one that I might very well just shut down tomorrow before I leave for my road trip, because that's one that I already know in advance is gonna be a problem child for me, I would have some sort of a risk if I would just kind of let it unfold if the wrong thing were to happen there. But all in all, I would say we're in pretty good shape here, right? I just rattled off 15 trades and we're only losing money on 2 of them. So 13 out of 15 trades we are profitable on. that's why I hope you guys get value out of these longer form videos where I show you trade application examples, right? It'd be one thing if we were losing 13 out of 15 trades. Then I could see why you wouldn't want to take the 5 seconds out of your day to click like for me, because maybe you don't want me to present a new trade idea for you the next time I do the video. But I would have to believe that if I were in your shoes and I was watching a free video on YouTube and they delivered 13 out of 15 profitable positions, that I would want to support that video however I could, especially if it was only a 5-second requirement out of my day to click a like button on Twitter. So that's my encouragement to you at this time. Now keep in mind, I won't be this good in the future. So in other words, this has been a particularly strong time for my trades. There will be plenty of times in the future where the profits don't come nearly as easily. So I don't want to put that pressure on myself either. But point being, at least by doing these longer form videos, I give you the opportunity to look at the trade ideas, and then you can decide for yourself if you also agree with the analysis and it's something that you want to take. And of course, we're all happier when there's more profits than losses. All right, let's go ahead and now talk about our new trade application example. And as I mentioned before, it's on Union Pacific, the big railroad company here in the United States. You can see the fills up here at the top. We sold the 175 put. Now this is the weekly contract for August 26th, and we got filled at $1.82, so just over 1% return on risk. So let's go over here and let me show you what had caught my eye with that one. And what was interesting about it is what caught my eye a half an hour before the market closed today did not actually end up closing with that signal. So let me explain. At the lows of today, Union Pacific had an oversold weekly cluster. Because of the slight bounce it had at the end of the day, so if we were to look at Union Pacific on a one-day basis here, you can see that I sold the put somewhere right around this dip, about a half an hour before the market closed. But then we had this big rally, and I can actually probably see the exact time I placed the trade. It would have been at, well, it was only about maybe 10 or 15 minutes beforehand. So anyway, it would have been around right here. I'm kind of circling with my mouse where the trade got filled. I think I placed the trade earlier than that, but it took a few minutes before I got filled on it. It was a thinner contract because it was a weekly contract. But the point being, we did have a further rally after I got filled there. And so that kind of benefited my bullish trade, and that's why we're up 17 bucks on it already. But at the worst part of the day, when I was trying to look for trade ideas about a half an hour before the close, this one was showing up on my radar because it had an oversold weekly cluster on its long-term chart here. Now it's hard to see, but there was actually a weekly cluster that showed up on this weekly bar back on June 13th as well. And you can see we got a nice little bounce back the very next week after that. I don't know if that's going to happen in this case either. What I do know is that where it's trading right now, it has a yield of 2.52%. Now, according to my dividend stair-step charts, we want to buy this stock for the longer-term purposes only when its yield is above 2.57%. That's the average high yield throughout the past decade. Now, many of you know that I also prefer personally to buy stocks with 3% dividend yields, which explains why I chose to go with the weekly contract in this case rather than the monthly contract. Because typically what I'm seeking out for these trade application ideas is a 1% return on risk. Normally I go out to a monthly contract, so I first went out here to the August contracts, and I looked to see what I could get filled at with a 1% return on risk, and it was kind of leading me to like the 180 strike or maybe the 175. But it was probably closer to 180, right? You can see there's a 1% return on risk there. The problem is when I come over here and look at the chart, 180 is approximately right here. There's this yellow line associated with this yellow bubble that says 173.33, and what that represents is what is the 3% dividend yield for that. So if I would have sold the 180s and this stock continued to fall, I would be perhaps filled on that trade and be exercised on it with a yield of, I don't know, like 2.8%. So it would not be quite to the 3% dividend yield that I desired. So instead, what I chose to do is rather than going to the normal August monthly contracts, I decided to go out here one more week to the August 26th weekly contract. Here I could sell the 175s, and as I mentioned before, I got filled at $1.82, so a little bit more than the 1% return on risk. And if you took $181 away from 175, so 175 is the strike price minus 182 where I got filled, and then my break even if I'm forced to take ownership of that stock will be 173.18. So 173.18 is below 173.33, that number you see in the bubble here. So in other words, it would give me a 3% yield at that particular level. So normally I don't do weekly contracts because they're less liquid, but in this case, that was my reasoning behind it. I'm a big fan of this company. I once lived in Omaha where Union Pacific is headquartered, so perhaps that impacts my mindset, but these railroad companies are companies that have great economic moats. And we have had an opportunity in my classes in the past to scoop it up. I remember we bought it back here when it crossed a 3% dividend yield in January of 2016. Perhaps some of you were in that class with me when I was back at TD Ameritrade. So you can see that was worked out very well for us as we bought it down here close to $70. And even after a pullback from 278 earlier this year down to 206, we're still up tremendously from where we were back there. And then you had one other follow-up time to buy it with a 3% yield here during the coronavirus wipeout, but you had to be very quick on that. That only existed for about 2 or 3 weeks. So, fast forward to where we're at right now. Is it an acceptable trade-off to try to get filled with a 3% dividend yield in this current drawdown in the market? I think it's reasonable for this type of higher quality company. Okay, so that's what I had for you here today. Again, I will be on vacation moving forward. I'll still be in my trading room tomorrow morning, but then after that I'll be taking off. So the next time you'll hear from me in this free video will be a week from Thursday. David is currently still on his vacation right now. I think he gets back this weekend, so he may very well do a market outlook video this weekend for you, but the next few days there will not be a market outlook video. So just trying to let all of you know that in advance, so that way you're not wondering if something went wrong or something like that. Nothing's gone wrong. We just happen to be on vacation. So I'll look forward to seeing many of you when I return from my vacation. Until then, if you could do me a favor and click like for me there on Twitter, that'll allow me to try to find good trade ideas for you when I get back from my vacation. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.